So I'm just going to briefly go over what I said again. We have the three different colors. And I don't want to make this boring because I know that you can't really discern the three different colors as well as you should. Here's, if you see this, I'll bracket it for you with a line. This is green right here, from here to here. Now this is where all resistance to the upside is broken and price action predicts right in here. And you can see that on our trading chart, it sucks price right up. And that's the way I want you to think of this, as these colors sucking price action, because these are all leading indicators. Now, the chart goes to dark blue here. And here is where all resistance to the upside is broken, but price action is no longer predicting a move to the upside. Now, what does this tell you? And you see how price action starts to just jump around and start to move in a sideways direction. No, they're not, James. They're actually green. Here is dark blue. And then I'll show you our third color. And I'm just going to bracket them like this so you can tell. So on the green color, look upon this as price action and the fact that you've broken all resistance to the upside as sucking price up. Here, you still have that vacuum cleaner pull to the upside, but it's only because all resistance to the upside has been broken. Price action now is dissipated to the upside. What this may tell you as much as anything is don't trade short. And then we have the third upside color. Right. If I don't put a line in it, ignore the white. And I'm also going to show you, and here's the third color. And you'll see this on the video. This is light blue. I think that this might be teal. Now, this tells you that price action is strongly suggestive of an up move, but you still have to break resistance to the upside for the long trade. Okay, well, you know what, Toby? Some people are getting the colors, other people aren't. So I'm just going to bracket it. So I think of the three colors. Here's your dark green. That's your strongest pull to the upside. Here is just price action. That's your second strongest pull to the upside. Eight contracts. That's going to require $8,000 of margin, and I would probably have about $12,000 or $13,000 in your account. You may not need it, I hope, but you just want to give yourself a cushion. If it's $1,000 per contract on crude and gold. Price action, support, and resistance, Mike. That's it. Nothing else. But that's a lot. And it doesn't do it from your trading chart. It does it off of the higher time frames. Now, this color blue is dark blue, and this just tells you about $8,500, Joseph. I agree, Toby, about 2%. Absolutely. We're going to send out the updated version, Lonnie, this afternoon. So you're going to get the bias indicator that projects these colors exactly the way I have them today. Everyone's going to get an updated platform. So you have three levels of risk on a long move. You have the dark green, in which you have price action, and you know that all resistance to the upside is broken. You have your teal, which is light, which is kind of like a very bold blue, which just tells you price action, and then you have the darker blue. Now you can format the colors however you like. I just want you to know that you can change these colors. These are all inputs in the indicator. So if you don't like the colors that I've set, you can change them. I just want you to know what they represent when you get them, and then you can modify the background colors, in a way that suits your memory. I mean, if you'd like to make this green a darker green, and then a lighter green, and then a lighter green still, you can do all that. These colors are not set. I just want you to understand what they represent when you see them on my trading chart. That's the same thing for the down move. And this indicator, it's not easy to explain because it's not a standard indicator. Here's price action and all support to the downside broken right here. And you see right here, it's a gorgeous trade to the downside. Right here. Now here is your lighter pink. This just tells you all support to the downside has been broken. And then you have, I think this is called, I don't even know what this is called. I can tell you what color I have it as on the bias. I have, this is called bisque. And you can see you have inputs. You can make these any colors you want on the indicator. This is just price action. And I think these two are the strongest colors. When price action tells you, and when you have price action and all support to the downside, or all resistance to the upside. And then when you have the intermediate color, where you just have support and resistance, you could get a sideways market. There's the strongest down color. So I hope that everybody understands that, because I think it's a really, really good indicator. It's not to say, again, that you cannot get a good move without bias. It's simply telling you that if you want to maximize the predictive value of your trade, if you want to have the patience to wait for an alignment of bias along with a red 50 and a red 15 and the darkest bias on a move like this, this is going to be the safest trade and the one with the greatest positive predictive value possible. And it takes patience. But what I want the platform to do is to define predictive value for you. That's an 18-tick trade. Now, how many winners do you need in a day to be profitable? And all you do is need 3. Now, we're going to be modifying the direct entry to take a third. We're going to take a third on a 5-tick stop, and since we trade 4, we're going to go to 2. Our third trade is going to give us a $120 potential profit on only a $100 risk. So if we get 2 winners and we're up $480, the last trade will either leave us for the day up $600, or it will leave us for the day up $380. The direct entry method, Adam, is really where I just take the trades for you. If I see a short here, I'm going to call out the level, but we put software on your computer that communicates with your Superdome, and I take the trade. So it inserts it on your Superdome for you. No, Heinz, the bias indicator has nothing to do with the 3 line. Remember that bias is just 5 ticks, James, but here's the thing. We must get a 1-tick pullback. The direct entry system is coded, and this is one of the this is No, what we're going to do, Mike, is we're going to make it so that right now, that's exactly what you would have to do. If I went to two contracts on a 5-tick stop, everyone would have to open up all their charts, type in the new direct entry, and then change the direct entry on their superdomes. We're going to make it so that I can do it automatically for you. I can change your ATM strategy to two contracts or whatever you want. We're going to have a second ATM strategy that I can dial in. You can format it, or we'll format it for you, and it's going to be an ATM that's going to trade less contracts with less risk. So if you make your full target on our first two trades, your third trade is going to be with reduced risk and with reduced contracts. Yes. Let's say if you trade 6 contracts, Joseph, what we would do is we would dial in for you a reduced number of contracts. I would recommend you have that to 3, but you can do whatever you want with that second ATM. And what I would recommend, because what we're going to do in the room formally is we're going to go to a 5-tick stop. So initially, you're trading 6 with a 10-tick initial trailer that's really only 9 ticks because we need that 1-tick premium, that 1-tick pullback to get into the trade. Now you're going to go to 3 contracts with an initial trailer of 5 ticks. The mandatory 1-tick pullback is going to give you a 4-tick stop. So really, your maximum loss on the trade, if you trade 3 contracts, is going to be 3 times 4 ticks, which is $320. If I do that right. No, it's not. It's not 320. Let's see. It's 4 ticks, $240, and your maximum profit on the trade is going to be 6 ticks times 3. Which is $180. So your risk to reward is skewed incredibly in your favor. If you lose your third trade, you still have a nice amount of profit for the day on reduced risk and the fact that you're only trading half the number of contracts. This way we can go for a third trade without risking 50 or 60 or 70% of our profit. And if we get those first 2, we're going to go for a third, and I can do that for you automatically. And we'll have that in about a week, a week to a week and a half. Right now, we're just going to go for the 2 and out. Like I said, we're going to look for 2 trades, $240 each. And what I'm going to do is I'm going to take the trades that have the highest predictive value, and that would be this long. This long is a retracement. There's no signal, but it's coming off. I'm not putting that in yet. We've got a green 50. We've got a green 15. We're coming right off support, and background bias is green. And that gives me the most predictive value I can get right now with the information that the trading chart is projecting. Now, the same thing is happening here. Now, this color blue is telling us that price action is predicting that the move is going to go, price is going to go to the upside on our trading chart. And I like this color a lot. I like this better than just this dark color here, where we just have support, where we just have resistance broken. I always want price action in my direction. And I get that with 2 of the 3 colors to the upside and 2 of the 3 colors to the downside. You know what, Mike? Win-loss. I hope that doesn't happen. But I think that if we go win-loss, win, we're done. I don't want to try. I want to try to take only 3 trades a day, because I really want to hold commissions to a bare minimum. If we get a win, then a loss, and then a win, we're up about $120 to $150. Is it on 4 contracts? Is it a killer day? Definitely not. But if we make $200 a day on average, that's $50,000 a year. If we make $300 a day on average, that's $75,000 a year. So, and this is aside from commissions. So I don't want commissions to drag this, our net equity for the month down. What we're going to start doing is when we do our net month totals, we're going to start subtracting out commissions. Because what I want to do is have a clean $4,000 a month minimum of profit, or $1,000 a week, to clear that $50,000 a year baseline. So we want to stay very, very low with the number of trades we take. And if I take a win and a loss and a win, we're done. Now I know that to some, after taxes, very nice, Alan. Nah, the taxes are on your side. What can I tell you? That's what I can't account for. Except if you send me your income tax returns, I'll give you a refund. But what we're doing for is we're looking for just a few trades. Now there's some traders in the room that are just terrific traders. They can take 3, 4, and 5 winners, bang, bang, bang. And like I said, they are better traders than me, and I don't mind admitting that. But what I mean, we without stepping on my words here, what we're trying to do really is, I think that in the first few months of trading the room, I really tried for a net equity much higher than necessary. I mean, I was trying to make $500, $600, $700 a day, and those kind of figures are just not achievable on a regular basis, until I sat down and I just did some of the numbers. And I've had multiple discussions with Dean Hadley, and he told me that I can use his name because he's going to ultimately recommend us as one of the trading platforms, because he sees the precision of our entries. I mean, they're not nebulous. We don't do retrospective calls. We have a direct entry system, and we rise and fall on our signals. It's a very transparent system. And one of the things he said to me, correct. Yes, we do, Mike. We don't trade at the opening of the pit. I took on the one really bad day I had in the last 10 trading days was I traded 30 seconds after the opening of the crude pit, and bang, I had a loser. And I don't like to trade the opening of the Russell. Sometimes it gives you. The Russell opened on Wednesday and just went right down into the toilet. I mean, if you're willing to take the risk, remember, the platform defines risk. Ultimately, as a trader, you've got control of your Superdome. If you want to trade the opening, you can do it. But I think you want to wait for the Russell to settle down. You don't want to trade the opening of the crude pit. And you also don't want to trade news, because the market goes ballistic sometimes. It's unpredictable. A lot of people will, bracket trade news, but I think it's crazy to do that. We've got a great platform that gives you a tremendous predictive value on the trade. Why, throw it out the window and start guessing? That's pretty funny, Alan. I like that. Now, the other thing that I've looked at, and this is really more for people who see the system, is that these breaks, these bounces off the 50 with the darkest bias are very good trades. If you can't see the color, there's the dark bias. You just need room to your first target before you hit resistance to the downside. They work, and we're going to start taking these trades. Here's another one. Now this is right into support, and look what happens. Loser, loser. But when there's room, they go. And we'll find some more. It's just we want to take just clean bounces with bias. Because I want to try to look for a loser where there's a bounce off the 50 with bias that then overruns the trade. And you can see that these are very, very tight to resistance. We wouldn't take these trades. And you don't get that many really good bounces. And I'm trying to find one. I don't see one yet. We just saw a few. Well, it's a little tight, but there's a bounce, successful. This one I wouldn't have taken on the trading the right edge because it's right into resistance. Correct, Mark. But remember, these colors, like I said, these are going to be your default colors. You can change the colors to whatever you want. What's important for me to have you understand is what they mean. That's all. And let me open up the indicator and just show you on the inside, just so you have a really, really good understanding of it. You have down, down. Now this is how Leo coded it. The down price, that's where you have support. Support and resistance. No, don't worry. No, that's okay, Leo. Now, down means that you have support or resistance broken, and you have price action. Down price color is just support or resistance broken, and middle down means you just have price action. So price action and support resistance only. Price action only. These are the three colors. This is how I coded them. You can code them any way you want. Correct, Toby. But like I said, you can do these any way you want. And I'll just show you something really interesting. What we did was we put this default on here because we wanted to make sure that the indicator was working, and it actually tells you whether it's middle down, down. I mean, it labels every candle, and it tells you. You see, this is up. That means you have price action, and you have broken all resistance to the upside. So you're not going to use this, and it's too tiny really to even project. But we put that in there to make sure that the indicator was working right. But it will come as a default on your indicator. So what I want to do now is I want to put in. I just wanted to show you. Can everybody still hear me and see me? Because I'm getting some strange noises from Hakam. All right, I'm going to log out and log right back in. Okay, I hope everybody can hear me now. Everything okay now? Okay, good. I'm going to reopen the chat. That's open. Okay. And I just wanted to show you what I saw. Um, you have no charts? All right, hold on a second. All right, hold on. Charts now? Charts okay now? Okay, good, good. I'm telling you. Okay, so um, just based on price action, um, I, and studying the charts, this is a pattern that I saw that is really, really a powerful pattern that I just wanted that I'm going to trade that I just wanted to show. It's this break. Whoops. It's this break of the 15 and retracement right back with bias. I could not find a loser. Every time I saw this pattern, even with the pivots, you get your target. And it happens again here. You get the break, you get the retracement with bias. Right here. Now the modified 15 is yellow, but you get the break and you get the retracement. And down you go. It happens here again. You get the break and the retracement. Now these moves, no pointer. Hold on one second. Leo, how come I have no pointer here? I mean, Hotcom is being a pain. I just logged off and lock up. All right, hold on. I'm gonna reshoot. All right, hold on. I'm gonna reshoot the chart. Hold on a second. Yeah, but some people don't, Leo. So hold on. Let me just reshoot. Hold on. I have so many crude oil charts up here. I have to find the right one. I think that's the problem. All right, how about that? Can you see the chart? Still blank? All right, hold on one second. Hold on. All right. How about now? Chart good? Yes, the background is all pink. And I purposely picked it because I wanted to show this recurring pattern. Break of the 15, retracement to the 15 and down with background bias. Break of the 15, retracement to the 15 and down with background bias. This one doesn't work because the 15's yellow. Break of the 15, retracement to the 15 and down. Over and over again. And now this is a single candle retracement. And I would looked at these over and over again. I could not find a loser. Even the multi-candles, and I just want you to see how powerful background bias is. Break, retracement, and up. You need a retracement within a candle or two. It happens right here. As soon as you see the break, look for the first retracement, right back to the 15 and down. And it's going to go. This is not really quite a break. This is really a break. I wouldn't have taken that retracement. Yes, you do, James. You really want that. If you want to minimize risk, stay with the color of the 50. And this is not really a great retracement, but listen, here there's a retracement back. You do have back. This is not the strongest. I believe this is the weakest background bias. This bias tells you that you have all resistance to the downside broken, and down you go. You got it. What we're trying to do, Toby hit it on the head, is we're trying to provide entries that avoid as much risk as possible. We know that we're going to miss good moves. Like here's a really, really great move. Here's a break, and here's a retracement. It doesn't come with background bias. You can take this trade, but you just know that you don't have support or you don't have resistance to the upside broken on the higher time frames, but there's wiggle room in between. And you don't have price action set up on the higher time frames. This is a higher risk trade. Is it a trade that you're not going to take? It's up to you. If I saw this trade in the room, knowing what I need to take, I don't know if I would take it or I wouldn't. I just don't know. I know what the lowest risk trades are, and really I'm defining them for you now without any indicators. Well, the stronger the angle is on the 15, the better, but I'll tell you, Mike, you don't really have to worry about it. Here it is again. The break, whoops, wrong, get the wrong number here, but you get the break, the retracement right back to the 15. It's a single or double candle break, retracement right back to the 15. I'm telling you, these are trades with background bias. You can take these trades to the bank. Now this is just a multi-candle. These are the big retracements, but with background bias, these really fly. 15 and 50 down. And I'm skipping the areas that don't have bias. And some of these trades do work. You just have increased risk. That's all really it is. Because we're certainly never going to catch every move. I mean, here it is. Again, break, retracement. Now, we're going to get a couple of these every day? Yes. On all the markets we watch, we're going to get them. There it is again. I didn't define these. I was just showing good entries. There's the break, there's the retracement, and down. Now, with no indicators here, we're purely basing these entries on price action and market structure. We are not conferring these with the three-line indicator. We don't have a momentum signal, a power entry, a strategy entry. We are just trading price action and market structure. And you see how powerful it is. And there it is again. It's a little more complex, but there's the up retracement right back to the 15. One tick above on the long, one tick below on the short. The thing is, on our direct entry system, Joe, we must get a one tick pullback to try to ensure that everybody gets into the trade. You can see this candle came with no pullback. If I took this trade in the room on the direct entry system, we would have not considered this to be a winning trade because people would not necessarily have gotten in. No, what we do is, well, we trigger the trade. You know, we make the trade complex because of the direct entry system, and I'll show you how we do it. Here's the range maker. What we do is, if this was a signal, our entry trigger would be 68.18, one tick above the close of the candle. But then the direct entry would immediately enter a limit order one tick back. Here, 68.25, our entry would be 68.26, but we'd look for that one tick pullback, our entry would be 68.25. So we look for a one tick wick on every entry. It gives us a one tick premium on our target and a one tick premium on our stop loss. Absolutely, James. You're going to get great trades on a yellow 15. Remember what I said. We're looking for specificity, not sensitivity. But here's what I want you to see about the yellow 15, and it's another thing that I noticed in reviewing the charts in the last few days. Correct, Joe. We look for the entry candles are trigger candle, and I'll show you it. Here's a trigger candle, and then I want to show you one other thing on that. So we have this move up. We have the retracement. We're going to enter based on this candle, but we're going to enter one tick above the close of this candle. Because remember, a candle close acts as a very weak area of support to the upside, or resistance to the upside, and support to the downside. So it's got to break the high of this candle by one tick. That's our trigger. Then the direct entry system enters the trade on a one-tick pullback. This wick would have gotten everybody into the trade, and up we would have gone on that. Okay? And I wanted to show you one other thing. Let's say that you have a prolonged area of a yellow modified 15, and you have bias to the downside. You're going to wait. And because our prediction based on price action, support, and resistance with this dark pink is that price is going to break down. Now, it doesn't always happen that way, but our prediction is we're looking for a short trade. So the modified 15 is telling us that we're in a period of consolidation here. And price action, yeah, you may get a great trade that sets up off of this yellow 15, but we're not looking for sensitivity, we're looking for specificity. So we're waiting for the market to break to the downside based on the prediction of our background bias. And after chopping around for a while, it does exactly what we predict. It breaks to the downside, retraces right back into the 15, and there's our terrific short trade. Now, if it broke the 15 and the 15 was yellow and just went straight down, we can't get it. And we're not going to get every trade. But we predict that after a period of consolidation, right here, the yellow modified 15, Toby, I totally agree. And that's really what I'm trying to point out, is that when you're in this long period of consolidation, look for the breakdown of the trade in the direction of bias. And here it is again. Now, this probably wouldn't be a trade we could take. The modified 15 is yellow, but there's the breakdown. When you get a little bit of yellow, the longer the yellow, the better. The longer the period of consolidation. Now, this didn't happen. Price just continued up, but eventually it collapsed. Our bias here is always to the short side. And what happened? We got a nice long trade. I mean, like I said, we're going to miss. Hold on one second here. Let me refresh this chart. I hope you can still see it. Can you still see the color? Because the color all changed. Can you still see the? Okay. The period that we were trading it is all the same, but I could see that what I needed to do was just refresh the chart. So all we're looking to do is define risk. We are not going to catch every winning trade. We are not going to prevent every losing trade, but until, I'll go a little bit longer because I just really want to I really want to get everybody up to speed on the platform. And I'm just going to go a little bit longer. I don't want to wear everyone out, and I'm fine. Toby, eventually we're going to do that. We just haven't had time to, but just looking at it and inspecting the chart, I think that the bias indicator really, really is helpful. Eventually we can do that analysis. I just want you to know that we're working on an ES Auto Trader that is going to be an absolute killer. We have run it for a year. It's an amazing auto. Now here's a big move up on an area where there's no bias. And transition periods are where you don't get bias because you have to break all resistance to the upside. It doesn't happen. And that's why I say you're not going to catch all the moves. But all you want to do is catch the winners. And here's the break again. I just saw it right here. There's the break. There's the retracement. Now here is a break and a retracement that fails. It goes a little bit too high. And it breaks through your trade. And if your stop is an 8 ticker, you're going to get a loser here. But I will never okay. I will never try to proffer to you that 100% of these setups are going to work. But all you need are 9 out of 10. There it is again. Break and retracement on the darkest pink, and down you go. It's incredible. And Jeremy, I'm telling you, I don't get enthused over very many things, but this ES Auto Trader is a killer. It generates $17,000 of profit per quarter, trading 5 contracts on a 21 range. We have not yet integrated bias into the auto. We're going to eventually do that. I mean, we have so many things to do. It's sort of pathetic, and we're trying to get everything done. Now, I want to add the 3-line indicator in. And because the bars are so small, the one dilemma I have is that, this is not the way to do it. I'm just going to hit OK. Initial stop is 10, Lonnie, but remember that with our tick of premium, that 5-tick target becomes a 6-tick target, and our 10 range, our 10-tick stop becomes a 9-tick stop. So what we're doing is we're looking to make $240 to the upside, which is 6 times 4, and the potential downside on a loss is $360, which is 9 times 4, which is $360. Now, the only way to make this, what I have to do is just format the wick thicker and the outline thicker to bring in the 3-line. And I looked at this last night. I got to make it about a 5. And it looks really awkward, but it's the only way to make it very obvious. And now there's the 3-line signal coded in. Now we're looking at a standard indicator. We're simulating from 2 time frames, order flow, stochastic, and we're encoding momentum. So let's go back at all the trades that I just outlined, and let's look and see if we're trading with order flow and momentum. Those are the 2 parameters that we know, and what I was trying to do was find a loser and see if we don't. Now here we have order flow and momentum on this entry. Here we have order flow and momentum on this entry. Take care, Joseph. I just want to go back on the trades that I just already outlined without looking at. Of course, now I'm not going to be able to find them, and there must be 10 or more on this chart. Hold on, let me. Where the heck did they go? Okay. Thank you, Toby. Let's see where they are. Yep. Order flow and momentum. Order flow and momentum. Now, those were two I think I found, but there were many, many, many more. Let me see where they went. So I can find more of them, but I traced out so many. There's another one. Order flow and momentum. Now this, oh, you know what I have to do? I think I have to refresh. Here we go. Order flow and momentum to the long side. Here's another one. Order flow and momentum with us to the short side. Now this is another one. I just put this line in myself. If I take it out, order flow and momentum with us to the short side. So what I have seen is that market structure and price action pretty much run the show, and the three-line indicator serves to confirm something that we already know to be true, and that is that these breaks and retracements are already going to be very, very successful trades. And I'm not sure. I believe that they add more because I haven't really done a really, really detailed analysis of them. Here's another one. There's the break. I would consider that to be the retracement. And we've got order flow and momentum. Now we just don't quite have background bias. I want to get that initial break. Now here's one. Well, this is two candles. I want to get a quick break in retracement. No, you do not need a VPS, Ken. You do not. I do, Jerry. I think, James, if it's not refreshing, I think you just have to sign out and sign back in because everyone else is good. I think that the bias indicator, because it's looking at multi-time frame, here's another trade. We did not look at this. Has order flow and momentum with it. Order flow and momentum with it. I don't know how much the indicator confluences add when you assimilate price action and market structure for multiple time frames. Here's a beautiful trade. Up. This is what I'm looking for. The initial break, the single candle retracement right back to the 15, and then up. And they almost always have order flow and momentum with it. It's uncanny, but they do. And there's another trade to the upside. And this is what we're looking for. Now here's unfortunately a move to the downside that we just can't get. Now, I just want to talk about one more pattern that I've seen that the bias indicator allows us to take with a lot more certainty. I've always been a break and retracement. It may sound funny, but a break and retracement man rather than a break. But if you get a break, and these are in our trading rules, but if you get a break of the 50 like this, with order flow and momentum, these were trades we used to take always. But I'm always concerned that the candle is going to turn and come back to the 15. So I shied away from the trades after a while. But if you have background bias with you, we're going to take these trades. Because I look through these charts, I look through months of these breaks. Whoops. Better get rid of that one. Hold on one second. This is like 4 miles long. Let me find more of them. We only want to take the breaks with 15 and the 50 have to be down. I mean, this one's not the best setup. It's a little bit of a chase, but down you go. So we're going to be taking these breaks of the 50 with you must have order flow and momentum with you, and you must have background bias. And I am not going to wait for the retracement back to the 50. You see this break? Well, this is not a break. We've got a yellow 15. It's no good. The 50, you know what? The 15 works just as well. Yep, Jerry, that's really what we're looking for. You just defined it, basically. Here it is. There's the break. This is a full candle. It's a winner. Now, we're trading right into a pivot. We wouldn't take the trade, but I just want to really sort of demonstrate it as a break of the 50. Here's another. Well, the break of the 50 is here. It's a winner. It's going to get you the 5 ticks we need with a 1 tick premium to give us our target. There's our 2 bounces off the 50 with bias. Listen, the crossing over the 15 and the 50, you cannot get bias on your trading chart unless the 15 has crossed the 50. Now, you cannot get bias on the background unless the 15's crossed the 50 on the higher time frames. That's part of market structure and price action. You will never see this pink background unless the 15 has crossed the 50 on the 13 and the 21. You just have to wait for it to cross on your trading chart. I mean, this doesn't nullify any of our rules on our trading chart. All it does is work to help solidify the trading rules that we already have and diminish risk. I'm trying to find a good break of the 50 or the 15, and when you're looking for it, it's hard to find. And I only want to do it with bias. And basically, I would like to look for a loser, and you're going to see that they're pretty hard to find. There's another break and retracement with order flow and momentum. Here it is again, really, too. There's the break. There's the retracement. Well, actually, that's with blue bias. Wouldn't take that short trade against bias. But here it is. Break, retracement, order flow and momentum, background bias. Up we go. But I'm looking for just a break of the 15. Now, I just wanted, and this is really going to be the last point I'm going to make, because I think we're running into an hour and a half. The point is that one, you must have the 15 and the 50 with you. The 15 is going to hold you up on some trades, and it's annoying. But if we don't let that 15 turn red, we're going to get suckered into a lot of losers, and it really, really does protect us. This period of yellow is a period of consolidation and chop, and we cannot trade it. I mean, we have to have patience. The only other thing I wanted to say, I'm trying to remember what it is because I'm losing my own train of thought. I'm just trying to look for a break of the 15. Oh, on a break of the 15, and we did this with an enormous amount of analysis. So I want you to know that this was done with retrospective testing over a very, very long period of time. A break of the 15 or break of the 50 must come where there's a full candle below the trend line and then the break. And I want to just show that to you because I think that it's probably and it's my fault if it's not well understood. But I want to show you a good break of the 15 or the 50, and I want to show you a bad one. And that's going to be the last thing, because there may be trades that you see that look like breaks of the 15 that work, but they're not really breaks of the 15. As we define them and the way we found, create the environment to give you a very, very safe trade. Let's just pretend that this was red, just to save time. Right here. This is a break of the 15 because you get one full candle above the 15 and then the break. You have to have a full candle above it or below it and then the break for the break to occur. Otherwise, the concern is that you're just breaking on chop. So in other words, what we're saying is market structure must define a trend, and a trend consists of two candles of the same color in a row. So you must have a red candle above the 15 and then a red candle below the 15, or a 2/3 candle close below the 15, before that is really a break of a trend line and the way we define the break of the 15. If this is a green candle and then a red candle, then a green candle, and then you have the red candle break the 15, that is not a break of the 15. And those have a lower probability of success than the ones where you've got this nice red candle first, followed by another red candle. Now we have a downtrend. Remember, two red candles in a row. If this candle broke the 15 and the 15 was red, there's our break. Same thing with the break of the 50. We need a break to the upside. We need a green candle and then another green candle breaking. At least 2 or 3 candles can be better, but you need at least one. You can't have price chopping above and below the 50 and then a launch off the 50. That is not a break of the 50. Sure. Something I would love to, let me see if I can find one. I know I will find one of them somewhere. Right here. Now it doesn't have bias and it works, but that's irrelevant. There's a bad break of the 50. Now if this is a C candle, remember we have indicators, but I haven't put in. Now if this is a C, you may want to take the C. It's coming off the 50. It doesn't have bias, but we define risk, and I don't want to go back on what I'm saying. Remember, we are looking to define risk, but as a break of the 50, this is not a break because we've got this choppy move up and down, and this is not considered a break of the 50. Even though market structure-wise it's broken the 50, this candle is not the continuation of an uptrend. It's got a prior red candle. And a break of a trend line has to come with a trend. So you need 2 green candles in a row. So taken in isolation, this is a bad break of the 50. And let me show you one more. I want to show it to you with bias. And again, whether it works or doesn't work is really irrelevant. Okay, here's a good break. Right here. Let me just go to the box. See how well this breaks? You have a trend. Jesus, I can't draw anymore. Right here. Now we don't have any of the other parameters. The 15's yellow, this is yellow. But structure-wise, we have this nice green candle below. It breaks above, and this is a break of the 50. If we had the 15 green and the 15 green, and we had background bias with us, there's your perfect break. And I just showed you the bad break. The bad break just chops along the 50. Then you get a green 50, a green candle, and it launches off the 50. Those aren't breaks. Just like, okay, let me show you here. If this was green, and you're going to see this same pattern occur on a green modified 15. Here is a good break of the 15. Can't take it, but we have the candle below. We have a trend, and this is almost a complete candle below the 15, and then we get a break above the 15. So market structure-wise, there's our break. Remember, in order to take the break, we need order flow and momentum with us on the candle. So I hope that really defines better for everyone what we're doing. When we start on Monday, I mean, I really like a really big panoramic view of the market, but we just can't get that with HotCom, because in order to trade three markets, and I like to trade three markets because we don't get these really juicy setups that often. And I just had a guy who emailed me yesterday, and he told me he averages between $500 and $1,000 a day trading just crude oil. But he trades about 6 hours a day. He trades between 9 o'clock in the morning and 3 o'clock in the afternoon. And he just sits in front of the crude chart, and he waits for those trades that have the highest predictive value of success, and he takes them. And he wrote me a really, really nice letter, and he's not a guy in the trading room. And I've talked to him on the phone. He just has tons of patience, and he's got lots of time. And I mean, $1,000 a day. We have people in the room who do that. But between $500 and $1,000 a day, I mean, that guy is making a great living from doing this. So I just want you to see that there are lots of ways of doing it. And there's nothing wrong with trading 6 hours a day on one market. The system gives you the trades. You now have background bias. You see how important it is, how critical it is in terms of the predictive value of a trade. It's going to miss good moves, but we don't care. You can trade with sensitivity or specificity. We want to trade with specificity. They're good moves we're going to miss. What we want is when we get into a move, we want it to be a winner. And we have almost every parameter defined. So simply with patience and a strict adherence to the rules on three markets, we should be able to get 2 to 3 winning trades a day. And if not, I mean, it's almost like shame on me if I take a trade that doesn't have a tremendous positive predictive value. Now, once in a while, we're going to take a loss, but we should really be 85% or greater in our winning percentage based upon all of this. Are you planning? No, I'm not going to, Mike. And I'll answer your question in a second, James. I'm not going to pare down the number of markets. What I'm going to look for, though, are the trades on those markets that have the highest predictive value. I am going to sit and wait for background bias because it is clear to me that background bias helps improve the predictive value of the trade. And so it's going to be, you're going to see trades that go by. Now, occasionally, I may take a trade without background bias. An engulfing candle right off a 50 with a 50 and the 15 green. Occasionally, you can stray a little bit. That's what pattern recognition is, and that's what discretionary trading is all about. But we really, 90% of the time, want to adhere to our rules. And just really quickly, James, sensitivity is a number of is true positives over true positives plus false negatives. That's sensitivity. Sensitivity is the desire to define every true positive move. And a true positive move is a move that when you get a signal, it works. If your target's 5, it goes 5. Specificity is the number of true negatives over the number of true negatives plus false negatives. Specificity is the desire to define the number of moves that if you took them would fail. That's the math of it. Now, it's not a given, it's not axiomatic that sensitivity and specificity are inversely proportional, but in day trading they are. As you endeavor to try to chase every potential winning move, you're going to suck in more losers. So as you increase sensitivity, you lower specificity. And ultimately, sensitivity over specificity equals the predictive value of the trade. What you want to do is strike a balance. And we want to push that balance hard towards specificity, because that's the only way to day trade for a profit. Now, if you want to take if you want to do a test that identifies a tumor in someone's head, you want to err on the side of sensitivity. You don't want to miss, you want to get a false negative. So you'd rather pick up a mass that wasn't really there than miss a mass that's there and you don't see, because you can do additional testing to confirm. But in this particular scenario, we don't have the ability to go back. If we don't trade with a tremendous amount of specificity, we're stopped out, and we're out our 4 contracts. So we've got to stick with specificity right from the start. We don't have time to backtrack with a lot of sensitivity and confirm with an additional test with a high degree of specificity. So that's where we are on the mass side. We have got to stay very conservative, stay with our trading plan, and enhance our specificity. You know what it is, Mike? I don't. Because the markets recently have been moving really slowly, and sometimes it's a little bit daunting, and I do miss trades. But I would rather miss a trade than break my rules. And I'll tell you, 99% of the losing days we have are because of me. It's not because of the system. I mean, the system is a real good one. And it's because I lose my dogmatic approach to day trading. And it's an emotional thing. It's a very, very tough business. And you just can't do it. And you have to be really sharp. You have to be well rested. You have to really, you have to be at the top of your game. If it wasn't so tough, everybody in the world would do it. Because what's a better business is to sit in front of your computer every day, and the trader who emailed me make between $500 and $1,000 a day with no worries, no muss, no fuss, no employees, basically no overhead. I mean, except for taxes. I mean, you're trading off of your computer. It's an awesome business, but it's a very, very hard one, because it takes a lot of skill and it takes a lot of time. And believe me, if you're going to be a great day trader, and I know that the great day traders do this, they study the charts after hours. They go back and they look at patterns. They look at the trades that failed. They look at the trades that won. Remember, a successful trade doesn't make it a good trade. You can take a really crappy trade and make money. But if you do that consistently, you're going to lose. You're going to bust your account. You can take a great trade that fails, and 1 in 10, and somewhere between 1 in 10 to 2 in 10 of our great signals are going to fail. That's why it's really important to sit and look at a period of consolidation. Look at the way the market breaks. Look at background bias. Now, I look and see how the three-line indicator helps enhance the predictive value of a trade. I didn't even put in our trading signals, the momentum signal, the power, because right now I don't think they're as important as understanding bias or on the three-line. Those are the keys. You can take a trade without a signal or ignore a signal. It depends on whether you like it or not. It really, really comes down to what we've got on the chart right now. The 50 and the 15 are key. Now background bias is key. Three-line indicator is a nice ancillary add-on. If you've got these with you, they're great. But on a break of the 50 or a break of the 15, you must have order flow and momentum. Must. Toby, it's a 2/3 candle. So is it 2/3 candle or complete candle behind the line? It's a complete candle, Toby. A complete candle. Correct. That's the way, because we went back a year and looked at market and looked at these setups. And when you don't have a complete candle below the trend line and then one above and they're both green, then what you can just be trading is chop. And it's not really a breakout, even if it has order flow and momentum with it. And these are the trades that are more likely to fail. When you've got the complete candle below and then you've got the break on a green 15 and you have order flow and momentum, that's a true break of the 15. Take care, Lonnie. Right now, Mike, we haven't really come to the point where I think we're making a difference, and that is why, though, we have moved to the strategy of requiring a pullback on every trade to get people into the trade. Like we had a trade. I know we had a trade on Wednesday, I believe, where there was no pullback. And it was a nice trade. And let me see if I can find it. Well, I'm going to have to reshoot the chart, and since we're coming to the end. And so basically, we must get a pullback on the trade to try to ensure that everybody gets into the trade. And the market is very, very gentle with you on a fill, on a pullback, as it is than it is on taking a buy stop limit order, where you force the market to give you your price at one tick above the close of the candle. Those used to leave a lot of people in the dust. The retracement trades, I believe, are getting almost everybody into the trades. Since we've started taking the retracement trades, I've heard very, very little problems with fills. So we're looking to take a retracement. Now, the issue of fills is a big issue. This is why we trade crude that has a lot of volume. This is why we trade the ES, which really, in essence, has infinite volume. I mean, the market depth is enormous. I am having a problem with the Russell lately because it's trading like 40,000 contracts, and it's traded very thinly. But right now, I don't see a problem. If more and more people are on the direct entry system and they start, we have a guy in the room who trades a 50 lot on the ES. He only trades the ES, and he trades a 50 lot. He's been in the room for 6 months, and he hasn't said a word. Although the last time I spoke to him, I was on the phone with him for 2.5 hours. And he's very successful taking our signals. And he is happy to sit on his hands for 2 days, waiting for a trade. And if he gets 2 trades on a 50 lot, he's looking for 3 or 4 trades a week. And that's all he wants. So if you're worried about fills, trade more contracts and just take the ES signals. You will get into every ES trade. Now, CL beyond all pivots. Obviously, Jerry, no problem, Mike. Jerry, obviously, I think volume is the driver behind every move. And there was a trade I took on the bad day I had where I took a trade where the market was moving like a snail. So volume is definitely key, and I think if you're going to break a pivot, you got to do it with conviction. You know what the problem with it is, though, is that we see it on gold. Gold just sits around and does nothing on no volume. Then all of a sudden it has a move with tremendous conviction. And as you get a candle that moves up, now I think you have to assess the overall market environment. When the market's dead, don't even try to trade at all, as opposed to trading into a pivot. But sometimes volume will surge and push you through the pivot. I think the best thing to do with pivots is stay away from them. I mean, I really think that they enhance risk, and what we're doing is we want to try to avoid risk. I think if you have bias and you have a C candle right into a pivot, and you're tight to the modified 15, so you're right near support on a long trade, I think you got a good shot of breaking the pivot. If you have volume with you, that's just another fuel in the engine to push that trade through the pivot. You know, these are all different parameters to try to make an assessment. It's a very, very tough call. But I think if I was tight to support, I had a C engulfer right into a pivot on good volume, I think I'd take the trade. You're absolutely right, Toby. But here's one thing that and this is really coming from Dean Hadley, who I think who really is an amazing guy when it comes to math. He believes that there's a natural harmonic to the market, and that on crude oil and the Russell and gold, that one tick is really part of the harmonic. And he doesn't feel that, and this is just his opinion, he does not feel that it really does detract from the momentum of the trade. Although I definitely see what you're saying, Toby, because some of the trades that we get that just fire through our entry, which I believe one of the things that power them through is that we're stopping out everyone in the failed counter trend move, and that helps give that thing a real shot in the pants. It's like a real kick in the butt, and that trade just fires through, and you're up 3 or 4 ticks without any hesitation, are very powerful. And I don't know if he's taking that into consideration. But the problem with the trades are they're not worth anything if the majority of the members of the room don't get them. So they are great trades. And I do agree with you. The one tick pullback is always a little scary to me. I like to see those trades just fire through, and before I can even think about it, I hear the ka-ching in the first target. But if we can't get 90% or more of people into the trade, it's not worth it. So that's why we are taking that little bit. We're banking on that one tick harmonic to not injure our trades, and to still see that they go through. This is the way you got to look at it. The trades are not valuable if you can't get them. And I'm in these trades myself, and a lot of them skip past me too. So we've got to take the trades that we can get into, and those one tick pullback trades, I don't think injure them as long as you take them and adhere to these rules. But we have seen that we've lost trades. And we don't book them when we don't count them. So we'll just wait for the next great setup, hope that the natural harmonic of the market gives it at least a 1-tick wick, sometimes even a 2-tick wick, very briefly, sucks us into the trade, and then everything just pulls us right back up into our first target. So listen, everyone. Correct, Jeremy. Now you can only lease it. Although if you buy the software package, you can also get the direct entry with it. Okay, thank you, Jeremy. I appreciate it. Listen, I appreciate it from everyone. I really wanted. Hey, you too, everyone. Everyone have a great weekend. Thank you so much, Alan. I mean, we're going to come out on Monday, and listen. What I told you today is going to be our Bible, our day trading Bible. We are going to wait for the juicy trades. We've got 4 markets to look at. We only need 2 successful setups. Within a week, we're going to be looking for a third on a great risk to reward. 120 risk on $100, 120 reward on $100 risk after we're already up $480 to try to push us to 600, or we'll close out the day with a $360 net profit. And if I'm having a bad day, we're going to close out with a moderate risk that we can quickly overcome on a winning day. So listen, I thank you, Perry. I really appreciate it. Everyone have a terrific and restful day. Don't do what is today? Friday. I'm losing track of the days. Go out and do some shopping and get for Black Friday. And Leo and I both wish you a wonderful and healthy Thanksgiving, which it's over, but it's still kind of the holiday. And hopefully we'll see everyone in the trading room. If you're not in the trading room now, you're welcome to come in on a free trial. Just go to the website. There's a link there for the free trial. You're welcome to sign up. We're www.rightlinetrading.com. You can call us at 1-855-765-6681. It's all posted to the website. We're going to be here all day. So everyone have a great afternoon, and we'll see you on Monday. So take care.